everyone, I'm Caroline Zakarian, and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to National Homeownership Month. Today's presentation is called Buying a Home and is brought to you by the Los Angeles Alliance for Economic Inclusion and the Los Angeles Public Library. Today, Lisa Hill and Michael Bailey from AEI will go over the process involved in buying a home, including information on loans, mortgages, making an offer, and closing on a home. We will have a brief Q&A after the presentation, so please send us your questions throughout the program. Take it away, Michael.
Thank you for the introduction, and I would like to thank the Los Angeles Public Library for hosting today's virtual workshop entitled Buying a Home. I am Mike Bailey, and my co-presenter is Lisa Hill. We will share information today from the FDIC Money Smart program on buying a home, brought to you by the Alliance for Economic Inclusion. Whether you're thinking about buying your first home, or you're getting back into the market after renting or other circumstances, this workshop will provide valuable information for your journey. Buying a home is one of the biggest financial decisions you'll make, and with the right information and preparation, you can make it successfully. Over the next hour, we will walk you through the complete home buying process, from determining if you're ready to buy through successfully closing on your new home. Next slide, please. And before we begin, let me share an important disclaimer. So this presentation represents the views of the speaker and not necessarily those of the organizations they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. Reference to any specific organization does not constitute an endorsement, a recommendation, or a favoring by the FDIC or the United States government. Next slide, please. So let me outline what we'll accomplish together in today's presentation. We're going to cover the complete home buying journey, starting with the foundation, which is determining if you're ready to buy a home and figuring out what you can actually afford. Then we'll explore your financing options because there are many choices available than you might realize, especially for first-time home buyers and those returning to home ownership. We'll discuss getting pre-qualified versus pre-approved. There is an important difference that could save you time and money. We'll talk about the professionals who will be part of your team during the home buying process and how to choose qualified, trustworthy help. We'll also walk through the process of making an offer, negotiating with sellers, and successfully closing on your purchase. Lastly, we'll cover what to do if you ever encounter difficulties with mortgage payments, and we'll introduce you to the LA Saves campaign, which can help you build savings for your home ownership goals. Next slide, please. So buying a home, let's start with that soul sign. That's everyone's goal. Next slide, please. But before we get there, we need to ensure you're truly ready for this major step. We will discuss how to get ready to buy a home and how to figure out what you can actually afford. Next slide, please. So our key takeaway, here's the most important concept I want you to take away from this first section. Buying a home is a process, not a single event. You want to start by making sure you're genuinely ready for home ownership and have a realistic understanding of what you can afford. This applies whether you're buying for the first time or returning to the market after a period of renting. Next slide, please. So now let me walk you through the 5 main steps in the home buying process. Step 1, get ready. This is where many people want to rush through, but it's actually the most critical step. You need to honestly evaluate whether you're ready for the responsibilities of home ownership, figure out what you can truly afford, and check your credit history. You can go to www.annualcreditreport.com and review your credit reports. That website is the only place where you can get free credit reports from the 3 nationwide credit reporting agencies. As of now, you can access your reports for free weekly at that site. So checking your own credit reports does not affect your credit. So again, that website is www.ANNUALCREDITREPORT.com. Step 2 is figuring out the financing. This involves learning about mortgages and other financing options, shopping around with multiple lenders for the best terms, and getting pre-qualified or pre-approved. Next slide, please. Step 3, shop for your home. This includes assembling your professional team and finding a home that fits your needs and your realistic budget. Step 4, buy your home. This covers making a competitive offer, negotiating terms, getting a thorough home inspection, and successfully closing on the property. Step 5, maintain your home. Remember that home ownership responsibilities continue long after you receive the keys. Now let's focus on the affordability analysis, because that is where many buyers make costly mistakes. Next slide, please. All right, here's a crucial principle. Only you can determine what you can truly afford. Not your real estate agent, not your mortgage lender, not well-meaning family members. You are the only one who must make the monthly payments and handle the ongoing cost of home ownership. Lenders will tell you the maximum amount they're willing to lend you, but that maximum is often very different from what you comfortably could afford or would want to spend on housing. There are 2 main primary methods to determine your comfort zone. First is your spending and savings plan. This involves analyzing your actual monthly budget to see how much room you have for housing costs while maintaining other financial goals. Second is your debt to income ratio. This is a calculation that lenders use in the approval process, but you should understand it for your own financial planning. Next slide, please. Monthly mortgage payments, or PITI. When you're calculating affordability, remember that your monthly housing payment consists of more than just your mortgage. Your total monthly payment is called PITI, which includes 4 components. P stands for principal, the amount you borrowed from the lender. I stands for interest, what you pay the lender for the privilege of borrowing their money. T stands for taxes, real estate taxes that go to your local government for services. And then I stands for insurance, homeowners insurance to protect your investment. This is really important because property taxes and insurance can add several $100s to your monthly mortgage payment. Many people forget to include these costs when they're calculating what they can afford. Next slide, please. Debt to income ratio. Now let me explain the debt to income ratio in more detail, because this is a critical tool for determining what you can afford. The debt to income ratio is calculated by dividing your total monthly debt payments by your monthly gross income, and it's expressed as a percentage. This ratio shows what percentage of your gross monthly income goes toward monthly debt payments. Your monthly debt payments include credit card minimum payments, car loan payments, student loan payments, personal loans, and any other recurring debt obligations, and your anticipated monthly housing payment when you're calculating affordability. So here's why this matters. If your debt to income ratio is 40%, that means 60% of your gross income is available to cover everything else, like taxes, food, clothing, medical expenses, savings, and other living costs. Different lenders have different standards. Some lenders prefer a debt-to-income ratio of 36% or less, while others will accept up to 43%, depending on your credit score and other factors. Some lenders may have specialized programs that may accept even higher ratios. So generally speaking, having a lower debt-to-income ratio indicates more financial stability and a greater ability to afford your new housing monthly payment. Remember, this is an important point. The debt-to-income ratio shows how much of your gross income goes toward total debt. But you still have other essential expenses like food, clothing, medical costs that aren't included in this calculation. So even if you qualify for a certain loan amount, you need to consider whether that payment fits comfortably within your overall budget. Next slide, please. So let me walk you through this example so you can see exactly how this calculation works. So here we have someone with $2,045 in total monthly debt payments and $3,750 in monthly gross income. When we divide 2,045 by 3,750, we get 0.5453, which equals 54.5%. So what does this debt-to-income ratio tell us about this person's situation? So first, more than half of their income is already going to cover existing debt payments. This means they only have about 45% of their gross income left for everything else like taxes, food, housing, transportation, healthcare, savings, and other living expenses. So why is this concerning? Because that 45% has to cover both their taxes, which could be 20 to 30% of their gross income, and all other living expenses, leaving very little cushion for unexpected cost or financial emergencies. Second, many lenders would not approve a mortgage loan for someone with a debt-to-income ratio this high. Most conventional lenders prefer to see ratios of 43% or lower, including the new mortgage payment, because statistical data shows that borrowers with a high debt-to-income ratio are more likely to struggle with mortgage payments or default on their loans. Lenders want to protect both themselves and borrowers from taking on unaffordable debt. So the question becomes, can this person afford to purchase a home right now? Probably not, at least not without making some changes first. The debt-to-income ratio is likely too high based on most lender standards. But here's the important part. This person has options. They could lower their debt-to-income ratio by paying down or eliminating some of their existing debt to reduce that $2,045 monthly payment. They could look at less expensive homes, which would result in a lower monthly mortgage payment, making a larger down payment and borrowing less money, which will reduce the monthly mortgage payment. They could also ask a family member for help with the down payment to reduce the loan amount, or looking into federal, state, or community programs that might help with down payment assistance or down payments or closing costs. The key point is a high debt-to-income ratio today doesn't mean you can never buy a home. It means you need to create a plan to improve your financial position first. Next slide, please. So before we move on to financing options, let me reinforce the most important message from this first section. Buying a home is a journey, not a transaction. Start by asking yourself, am I truly ready for home ownership? What can I realistically afford? Laying a strong foundation by Assessing your readiness and setting a sustainable budget is absolutely critical to your long-term success. Never let anyone rush you or push you beyond your comfort zone. A home that stretches your finances too far isn't a dream, it becomes a burden. So it's worth taking the time to get this right from the very beginning. By being thoughtful and realistic in your planning today, you're setting your future self up for success, and trust me, you'll be grateful you did. Next slide, please. So now we're moving into section 2, where we'll focus on financing your home purchase. So first, we'll identify the different types of mortgage loans available to you. You have more options than you might realize, especially if you're a first-time home buyer or meet certain criteria. Second, we'll define important loan terms and concepts that you'll encounter throughout the mortgage process. Understanding this terminology will help you make informed decisions and communicate effectively with lenders. Third, we'll discuss how mortgages actually work, the mechanics of how you'll pay back your loan over time, and what factors affect your monthly payments. And finally, we will discuss the importance of shopping around for a mortgage and how to compare offers from different lenders to ensure you get the best deal for your situation. This section is all about empowering you with the knowledge so you can make informed financing decisions. Next slide, please. But before we dive into details, let me share the key takeaway for this financing section. Know your loan. Learn about your financing options for buying a home and shop around to get the best deal for you. I want to emphasize those last two words, for you. The best loan for your neighbor, your coworker, or your family member may not be the best loan for your specific financial situation. Your income, credit history, down payment amount, and long-term plans all factor into what makes a loan right for your circumstances. Next slide, please. All right, so let's start with some fundamental definitions that you'll encounter throughout the mortgage process. A mortgage is simply a loan specifically designed to buy your house, condominium, or townhome, where the property itself serves as collateral for the loan, which means the lender can foreclose if you don't make your payments as agreed. So again, a mortgage is simply a loan specifically designed to buy your house, condo, townhome, where the property itself is used as collateral for the loan. The principal amount is the actual amount of money you borrow from the lender. This is the base loan amount. The cost associated with getting the loan includes several components. Interest. This is the cost of using the lender's money expressed as a percentage. Points. Some lenders may offer you the option of buying points, where you pay more money up front in exchange for a lower interest rate. Points can be a smart choice for some people who plan to keep the loan for a long time because the monthly savings from the lower interest rate will eventually add up to more than what you paid up front. Fees. These can include lender charges for processing your application with various names like application fees, processing fees, and underwriting fees. Other charges, such as appraisal fee, to determine the value of the property. The annual percentage rate, or APR, is the number you want to focus on when comparing mortgages. Lenders are required to tell you the APR for any mortgage you're considering. The annual percentage rate reflects the total cost of a loan on an annual basis, and it encompasses not only the interest rate, but also additional fees and charges associated with the loan. This distinction is important. Relying solely on the interest rate can be misleading, as each lender may include different costs. By using the APR, you gain a standardized measure that allows you an accurate apples-to-apples comparison across loan offers. This is why APRs are so valuable for comparison shopping. Next slide, please. Now let's talk about down payments, because there are many misconceptions about this topic. The down payment is the portion of the home's purchase price that you pay in cash at the time of purchase. So let me walk you through a specific example. Let's say a lender requires a minimum down payment of 5% to approve your mortgage. If you're purchasing a home for $600,000, that means you'll need to contribute at least $30,000 up front. That's because 5% of $600,000 equals $30,000. The remaining $570,000 would be the amount you borrow from the lender through your mortgage. So here's the key relationship to understand. A higher down payment means less money to borrow. When you put more money down, you reduce the loan amount, which typically results in lower monthly payments, less total interest paid over the life of the loan, no private mortgage insurance requirement if you put down 20% or more. However, and this is important, you don't necessarily need a 20% down payment to buy a home. Many home buyers purchase with significantly less money down, as shown in the 5% example we just discussed. Next slide, please. So let's take a moment to talk about private mortgage insurance, or PMI. If your down payment is less than 20% of the home's purchase price, your lender will likely require you to carry PMI. This is common for most conventional loans. PMI exists to protect the lender, not you, in case you stop making payments. So it's not the same as homeowners insurance. Homeowners insurance protects you from losses due to things like fire or theft. PMI, on the other hand, protects the lender's investment, much like gap insurance on a car loan. Now here's the part that affects your budget. PMI increases your monthly mortgage payment. The exact cost depends on your loan amount, your credit score, and how much you put down, but it's often a noticeable increase. PMI can help you buy a home with a smaller down payment, but it will raise your monthly costs. So it's something you'll want to include in your affordability planning. The good news is that PMI isn't always permanent. Depending on your loan, you may be able to cancel it once you've built enough equity, either by paying off a certain portion of the loan, which is generally 78 to 80%, or after a specific number of years, like midway through the loan. Some lenders may require PMI for the entire term, so be sure to check with your lender and your loan agreement. Next slide, please. So earlier, we talked about 4 parts of a typical mortgage payment: principal, interest, taxes, and insurance, often shortened as PITI. Now let's focus on how you'll actually pay the taxes and insurance portions. There are 2 main ways this is handled. One option is through an escrow account. With this method, your lender collects a portion of your annual property taxes and homeowners insurance through each month as though they're part of your mortgage payment. Then, when those bills are due, the lender pays them on your behalf using the funds held in escrow. This is a common setup, and if you're putting down less than 20%, your lender may require it. Option 2 is to pay these bills yourself when they arrive. While this gives you more control, it's less common, as most lenders prefer the security of managing those payments through escrow. It's important to note this type of escrow account is different from the escrow process used during the home purchase transaction. In this case, The escrow is ongoing and used to manage your taxes and insurance after you become a homeowner. Many people actually prefer the escrow option because it spreads large, once-a-year cost across monthly mortgage payments, making it easier to budget. Just be aware that your property taxes and insurance premiums can change from year to year. If they do, your escrow amount and therefore your total monthly mortgage payment will adjust as well. Next slide, please. Now let's talk about the first of two main types of mortgage interest rate structures, the fixed rate mortgage. With a fixed rate mortgage, the interest rate stays the same for the entire life of the loan. That means the principal and interest portion of your monthly mortgage payment will never change, offering predictable, stable payments month after month. But there's an important detail to keep in mind. If you have an escrow account, your total monthly payment could still go up over time. That's because property taxes and homeowners insurance can increase even though your mortgage rate stays fixed. So when is a fixed rate mortgage a good choice? It's a smart option if interest rates are low now and you believe they may rise in the future. Locking in a low rate protects you from future increases. It's also a great fit if you plan to stay in your home for a long time. Fixed rate mortgages commonly have a 30-year term. So if you're looking for long-term stability, this could be the right choice. The key benefit here is predictability. No matter what happens with market rates, your principal and interest remain steady. This can make budgeting easier and shield you from sudden payment increases, also known as payment shock. Just remember, even with a fixed rate loan, your monthly mortgage payment may still change if you escrow for taxes and insurance, since those costs can rise over time. Next slide, please. Now let's look at the alternative to a fixed rate mortgage, the adjustable rate mortgage, or ARM. With an ARM, your interest rate typically starts lower than a fixed rate mortgage, which means your initial monthly payments may be lower. But unlike a fixed rate loan, the interest rate and your payment can change over time, often increasing. Here's how it works. ARMs are tied to a fixed financial index, such as prime rate or treasury yields, and they adjust on a set schedule, like every 1, 3, 5, or 7 years. When the adjustment period comes up, the interest rate is recalculated based on that index and an added margin. So for example, a 3-1 ARM has a fixed rate for the first 3 years, then adjusts annually. A 3-2 ARM stays fixed for 3 years, then adjusts every 2 years. So when might an ARM make sense? It can be a good choice if you plan to sell or refinance before the initial fixed period ends, allowing you to benefit from the lower starting rate. You're financially prepared to handle a potential increase in your payment if rates go up and you're unable to refinance. Or an ARM loan may be good if you are conscious about your budget. And so if you wouldn't be able to afford higher monthly payments in the future, then an ARM loan may not be the right fit for you. Before moving forward with an ARM, be sure to read the Consumer Handbook on Adjustable Rate Mortgages. Your lender is required to provide it to you. Visit consumerfinance.gov and search for adjustable rate mortgages to get more guidance. The most important thing is to fully understand how much of your payment could increase and to be confident that you can manage that increase if it does. Next slide, please. All right, now let's talk about conventional mortgages, which make up the majority of home loans issued today. So mortgages generally fall into two categories: conventional or government-backed, sometimes called government insured. Conventional mortgages are not tied to any government program. That means there's no special eligibility requirements like military service or living in a rural area. They're usually open to all qualified borrowers, but may be more difficult for some people to qualify for compared to government-backed loans. So what you typically need to qualify for a conventional mortgage is, first, a strong credit history. Your credit score affects not only whether you're approved, but also what interest rate you'll be offered. It's a good idea to check your credit reports from all three major bureaus. You can do this, again, by going to annualcreditreport.com, the only official source for free annual credit reports. Second, you'll need to verify your income. Lenders want to see a steady and reliable income stream, which you'll need to document through pay stubs, tax returns, and other financial records. Third is your debt to income ratio, or DTI, which we discussed earlier, and that needs to fall within an acceptable range. While 36% is a common benchmark, some lenders may allow higher ratios depending on your credit score and the size of your loan and down payment. And finally, you'll need a down payment. Depending on the loan program and lender, this could be as little as 3%, though putting down 20% or more allows you to avoid private mortgage insurance, or PMI. The bottom line, conventional loans are flexible and widely used, but they do require a solid financial profile. Next slide, please. So while conventional loans are the most common, they're not the only financing option. There are several government-backed loan programs that may offer more flexible requirements or better terms, especially for first-time home buyers or those with limited resources. These include FHA loans, USDA loans, VA loans, and other programs supported by HUD. FHA loans, which are insured by the Federal Housing Administration, are a popular option for first-time home buyers. These loans often require a lower down payment, as low as 3.5% of the purchase price, and may have more lenient credit and income requirements compared to conventional loans. So if you're concerned about having or saving for a large down payment or meeting stricter credit requirements, FHA loans may be a good alternative. Next slide, please. In addition to government-backed loans, there are many other assistance programs that can make home ownership more accessible, especially for first-time home buyers. So there's down payment assistance programs, there's closing assistance programs, there's programs for first-time home buyers. There's some programs that are geared toward people in specific professions, so could be firefighters or emergency medical technicians. The bottom line, don't assume you won't qualify. Many of these programs have flexible requirements and income limits that are higher than most people expect. It's well worth taking the time to see what's available in your area. Next slide, please. So let's take a moment to talk about amortization, a key concept for understanding how your mortgage payments actually work. When you make your monthly mortgage payment, that amount is amortized, which means it's structured so that part of your payment goes toward the principal and part goes toward interest. With a fixed rate loan, this total payment amount stays the same every month. With an adjustable rate, it would change whenever your loan resets. Your lender will provide something called an amortization schedule or table, which is a breakdown of how much of each payment goes toward interest and how much goes toward principal. Here's something that surprises many first-time home buyers. In the early years of your loan, the majority of your payment goes toward interest, not principal. Now, here's where you can take control. Many mortgages allow you to make prepayments. That means paying extra money toward the principal. So even a small amount extra each month can save you thousands in interest over the term of your loan. So for example, on a $200,000 mortgage at 6.5%, over 30 years, your regular monthly payment will be around $1,264. If you add just $50 extra toward principal each month, you could save roughly $42,000 in interest and pay off your loan 6 years early. Even $25 extra a month could save you about $23,000 and shorten your loan by 3.5 years. Next slide, please. Getting pre-approved or pre-qualified. So let's take a closer look at the difference between pre-qualification and pre-approval and what each process typically requires. So pre-qualification is a informal way to get an estimate of how much you may be able to borrow. It's based on the basic information you provide to a lender over the phone or online. Pre-approval, on the other hand, is a formal process. It's a conditional commitment from the lender to lend you money. And it also shows sellers you're financially prepared to buy a home. In today's competitive real estate market, many sellers won't even consider offers unless buyers are pre-approved. Next slide, please. Now that you understand the basics of mortgages, it's time to talk about one of the most important and often overlooked steps in the process, shopping around for your loan. Surprisingly, nearly half of home buyers don't compare mortgage offers, but doing so can save you thousands of dollars over the life of your loan. Start by requesting a loan estimate from multiple lenders. A loan estimate is a standardized document that outlines the key terms of the mortgage, including the APR, as we discussed earlier. Since interest rates and fees can vary widely from lender to lender, even a small difference, say 1/4 of a percentage point, can cost you tens of thousands of dollars over a 30-year mortgage. Keep in mind, loan estimates are free. Although some lenders may charge a small fee for pulling your credit report, that's normal, but you should never be required to pay a full application fee just to get a quote. Remember, shop around for your mortgage. You want to use the loan estimate to compare offers between lenders. Next slide, please. So before we move on to working with professionals and actually buying your home, let's pause and reinforce the most important takeaway from this section. Know your loan, understanding your financing options, and take the time to shop around for the best deal that works for you. Your income, your credit history, your down payment, and your long-term plans all play a role in determining whether the loan is right for you. Don't assume you won't qualify. Many of these programs have higher income limits and more flexible requirements than people expect. The goal of this section was to give you the knowledge and confidence to explore your options, ask questions, and make an informed financing decision. This decision will shape your monthly mortgage and your budget for years, so make sure to take the time to understand your choices, compare loan estimates, and ask for clarity when you need it. Now I'm going to turn it over to our next presenter, Lisa, who will guide you through the next phase, actually purchasing your home.
Yes, section 3 is getting help and buying your home. Understand financing. In this section, we'll discuss how to put together a team of professionals to help you buy a home, the major steps to buying a home, and where to get help if you're struggling to make your payments on your mortgage. Next slide, please. The key takeaway is to get help with home buying process. You need to interview the professionals before they help you, and also ask for references of those professionals that you want to help you with processing through buying your home. Understand their services and you will receive, and how much you will receive on the cost of that process. Next slide. There are many professionals who can work and guide you in the home buying process. Some of the professionals are a real estate agent who can help find that home that meets your needs and wants. There's usually a whole team in addition to the real estate agent that is involved in the home buying process. You have an appraiser that provides an estimate of your home value. You have a lender who qualifies you for a loan and lends you the money and to help you buy that home. You have a housing inspector who identifies key problems with a home before you buy it. And then you have an attorney. Some states require an attorney to write the real estate contract and search the property and conduct closing instead of the real estate agent and the title insurance company. There's also a title insurance agent who researches the title on the property and makes sure that the seller has the right to sell that property. You have an insurance agent who determines whether the property can be covered by insurance and recommends how much insurance you'll need to have on the home. Also, there's a housing counselor who provides education and counseling on home buying process. These are HUD counselors approved by HUD and advise on buying a home. They also provide assistance at any stage of the home buying process and also help you with down payment assistance and other resources. And for this reason, it may be helpful to consult with the housing counselor before working with a lender. You can visit www.hud.gov/find a counselor or call 1-800-567-4287. Next slide, please. Once you find a house that you want to buy, you will make an offer. This is when you tell the seller, I want to buy your home, and this is how much I want to pay for it. Your real estate agent or attorney will write an offer. Next slide, please. What is an offer? An offer is a contract, or a contract is an offer to the seller, which includes their address, description of the home. It includes the sales price. It also includes the amount that you're offering to pay. And also you have to have a target date for closing. The amount of earnest money you're offering to pay is usually the deposit you're offering to let them know that you're serious, that you want to buy their home. And this is where it's also called a good faith. You may, if you cancel at any time, you risk losing that deposit. So it's important that you are really truly committed to go through the process of buying the home. Next slide. Here's some other things in an offer that are expected. There's a walkthrough clause stating that you have the right to walk through the property one more time before the sale is finalized. This is generally when the seller has moved out and you have a right to walk through before closing. The date you're offering expires if the seller wishes to offer you an offer. They must do so before that date that you request for the offer to expire. There's also contingencies. These are statements that must be true or the offer is void. This could include you getting financing and the results of a home inspection. There are also special requests. For example, the buyer must request that all appliances be included in the home purchase. Other terms required by law, it depends on the state, and it also depends on your real estate agent to help with looking at what's important to place in the offer. Next slide, please. When you make an offer, make sure that this is what happens. The seller accepts your offer and negotiations end. Your offer plus the seller's acceptance because is a legally binding sales contract. The seller rejects your offer and makes a counteroffer back to you. You can either walk away from the transaction because it's not legally bound contract, or you can accept or reject that counter offer that the seller is giving to you. You can also make a counter offer to a counter offer, and the seller could reject your offer and does not move forward with the contract. You yourself can walk away from the transaction because it's not legally bound, or you can present a new offer to the seller and the process begins again. As you can see, it becomes complicated pretty quickly. That's why it's important to have a professional help you through the process. If the seller accepts your offer or you accept a counteroffer from the seller, you will begin moving forward with financing and closing process of the loan and the home. Next slide. There's a home inspection, which is a requirement that offers that it's a contingency, which means that it depends on the result of the home inspection. These are unforeseen items that are happening in the home that you cannot see, but the home inspector will do detailed information about the condition of the home before you buy it, and it reveals significant issues with a property that may not appear without this inspection. In a home inspection, a qualified inspector goes in depth and has an unbiased opinion about the potential of the new home that you're purchasing. They will evaluate physical conditions, structure and construction, and mechanical systems. They will identify anything that needs to be repaired or replaced, and then also they will estimate remaining useful life of major systems like your equipment, structure, and finishes. In some cases, you may need a secondary inspector for your heating or cooling system or any other foundational issues that need further structural engineer inspection. In the markets where homes are selling very quickly, some buyers may decide to waive a home inspection. They may be willing to take the risk of buying a home and that has potentially unknown amount of needed repair work so that their offer is more attractive to the seller. Next slide. You can expect to get the following documents at closing: a loan estimate that lays out the information about your loan, a closing disclosure. This is a form that lists the final terms of the loan, a final closing costs, and the details of who pays and receives the money at closing. Your lender must provide this document to you at least 3 business days before closing. There's an initial escrow statement. This lists the cost of the lender's expects to pay from your escrow account. This includes estimated taxes, insurance premiums, and other charges during the first year of your loan. There's a promissory note. This is the document that details your loan, which includes the amount you borrowed and need to pay back, the interest rate, the dates that you must make the loan payments each month, and the term on the length of the loan, the total of the money you will pay back over the term of the loan, and the payment amounts can change, which means that, as Michael had explained, your interest and your insurance could go up during each year. Next slide. Closing a home. At closing, the loan becomes final. The funds are distributed to the sellers and the other professionals who receive payment at closing, like your real estate agent. Title insurance will be done. The lender will get their escrow, the monies, the taxes and insurance. Escrow will be refunded back to the lender at that time. So these are the things that are happening when distributing. Also, the title property will given to you right away. You also have to pay for title insurance. And then also recording by the county government is included in those costs. Next slide. It is important to get help if you're unable to make a mortgage payment. So the first thing you need to do is contact your lender to let them know if you're having an emergency or something is having trouble of making the mortgage payment. They may offer a modification, or they may find a program that could help you with that. Also, contact a home preservation hotline. It's open 24 hours a day. You can contact them at 1-800-995-4673 or visit www.995hope.org. Also, contact your HUD-approved housing counselor and find out if they could help you or identify other resources to help you with that. You can contact them or go to www.hud.gov/find a counselor or 1-800-569-4287. You can also contact your state housing finance agency and they will be able to help you with resources in your state. Next slide. The key takeaway is to get help with the home buying process. Interview any professionals you hire and make sure to receive references. Understand what services you will receive and how much they will cost you. Next slide. LA Saves. Savings is important to build finance, well-being. LA Saves is also an America Saves local campaign. What we want to start is start small, think big with America Saves. Set a goal, make a plan, take action by going to lasaves.org. Next slide. America Saves is a campaign coordinated by the nonprofit Consumer Federation of America and is dedicated to helping individuals save money, reduce debt, and build wealth. Los Angeles Save is a local America Saves campaign, and the website is lasaves.org. Next slide. Now, I want you to understand that savings is very important, especially if you're working towards homeownership. Saving your past, present, and future means you're creating financial security that serves different time periods in your life. Save by reducing debt is in your past. This is getting you ready to move forward with saving a down payment for your home. The next one is save for emergencies. This protects your present financial stability just in case unexpected expenses come up or emergency comes up. You'll have money set aside that can handle unexpected expenses like getting a new tire, medical bills, temporary reduction in income. Also, save for opportunities like entertainment, a vacation, an investment at some time, maybe investing your education or job training. This is important. Then also save to build wealth. This secures your future financial independence. It also helps you get ready to retire, also build equity in your home or other investments for your future. For those of you who are working towards homeownership, saving addresses all 3 time periods. You can commit to save by taking the Los Angeles Saves Pledge at lasaves.org. Next slide. Here's how you sign up. So all it entails is you taking a pledge. That means that you need your name, Set a goal, for example, to create emergency fund, vacation, buying a home. You pledge dollar amount like $20 per month, and then also how many months that you need, say 12 months. You provide your email address on the LA Save so they can keep in touch with you, and your phone number and a zip code. And if you want to check a box to receive texts with saving tips. You will only see 1 to 2 tips per month. Next slide. The reason why it's important to save is to build out a bank account. So if you don't have a bank account right now, this is a time that we would want you to put your money into a FDIC insured bank account, which offers financial safety, easy access to your funds, savings from check cashing fees, and overall financial peace. With you establishing a bank account, this provides a history for your mortgage application, because lenders will require you have bank statements to verify your down payment and your financial stability of affording a home. In order to learn about it, we have a bank account that's called Bank On with FDIC insured banks on a website at fdic.gov/getbanked. Next slide. If you don't have a bank account, then we have teamed up with Bank On Los Angeles County. It's not a bank itself, it's just an affiliate of the National Bank On efforts to identifying low cost and affordable bank accounts. The County of Los Angeles has joined this effort by creating Bank On Los Angeles County to share information and to provide a list of banks that offer low cost checking accounts, which are low maintenance fees, minimum opening deposits from $0 to $50, no overdraft fees, no ATM fees within the network of ATMs, and free check cashing, among helpful features. Next slide. So if you want to continue on learning about any Money Smart, if you want to learn anything about Money Smart, the FDIC has put together a self-paced online program that uses a game approach to showcase the topic. This is no cost to information on everyday financial topics. These are other resources. Next slide. And then next slide. Any questions? And I want to thank you so much for the opportunity. Now I turn it over to Carolyn.
Okay, we're almost at time. Thank you both for a great presentation. There, I do see, let's see. There's one question. Basically, Pauline wanted to know if she can see this again, and the answer is yes. I was just about to say, this program, like all of our streaming programs, will be available shortly on LAPL's YouTube channel. That's youtube.com/Los Angeles Library. So like even like just after the presentation, it'll be there on there indefinitely. So that's all the time we have for today. Thank you both again. So there's also going to be a Spanish language version of this presentation tomorrow at 12 noon called Comprar una Casa. So for more information on that program or any of our programs, go to our website at lapl.org/what's-on/calendar. All the information will be on there. Thank you both again and have a great rest of your day, everyone. Thank you so much. Bye-bye.
Thank you.